for like, I think 4 classes thereabouts. You said?
I'm not been feeling so fine. That is why.
Oh, okay. Just sorry about that. Apologies. So honestly, I'm supposed to reach out to you, but there's a lot. I'm sorry about that, please. So hope you are getting better now. You said? Okay. So please, if you have question for me, please kindly unmute your mic. Quickly unmute your mic. Quickly unmute your mic. Then you can ask your question, please. Unmute your mic and ask your question. So if there is no question, my sincere apologies for joining the. No, it's charged. So my sincere apologies for sending the link or joining the class late. Right, it was due to my network. I'm trying to log in. Right. So I'm sorry about that for joining late. Thank you. So in today's class, we'll look at another topic. It is not another topic like that, but it is also under. It is also. It is under. It is under valuation of a business. Right. This topic is also is under valuation of a business. I don't have notes on it, so you can see the notes in the drive, please. So value-based management is just, we move from free cash flow to the method of valuation, the asset base. Then from there we move to the merger and acquisition. Now, our valuation techniques will not complete without the mention of value-based management, because they are also used for valuation of a business. You can use it to value a business. Right. Now, examiner may ask you a question that may ask you to calculate either the shareholder value analysis, to calculate the value of a company using the shareholder value analysis, and maybe in the next question, maybe calculate the economic value added. Excuse me. Calculate the economic value added, or market value added, MVA, right? So the question is a form of valuation of a business, right? Now, what is value-based management? Value-based management is used when a company, wants to increase the value of their shareholder. Mainly, it's used to determine the value of share. It's used to determine the value of the company, of a company shareholders. Class, if there is an increase in MPV, if the MPV is positive, you will say this project will maximize the shareholders' wealth. If the free cash flow, or in calculation of the value, if the free cash flow of the combined company is greater than having an individual company, which relates to synergy, we will say, oh, this will maximize the shareholders' wealth. Is that not so? So the value-based management is talking about value, how companies can increase the shareholders' wealth. And how can they do it? If they want to increase the shareholders' wealth, or how to determine the value of the shareholders. Class, in determination of this, in determination of the increase in the shareholders' wealth, or let me pick it from how do we determine, what are the methods we will use to determine whether the entity is adding value to the entity, to the shareholder or not? What are the methods? There is the shareholder value analysis. This shareholder value analysis can be used to determine the value of a company. If you determine the value of a company, by extension, you are telling me that, oh, this is the value. You are increasing the shareholders because you are telling me that this is the value of the company. And if they have 50 naira as intrinsic value or the value of the company, meaning that my wealth will increase because I will have more cash flow. You will pay me because there is a value that has been added to the world, to the company. The shareholder value analysis can be used to determine the value of a company. Economic value added can be used to determine the value of a company. Then the MVA, the markets MVA, market value added. All right, market value added can also be used to determine the value. Now, right, can be used to determine the value of the shareholders. Class, the value-based management is a techniques or is a technique that is used to determine, or that companies use to determine the increase in the value of a shareholder. If you want to know if the value of the shareholder is increasing, you can either use the shareholder value analysis, the market value, the economic value added, the market value added. So in today's class, we shall look at the shareholders value analysis. Class, am I communicating, please? Am I communicating?
Not yet.
Yes, sir.
Okay. Now, if that is established, I hope you are right to know. If that is established, in determination of this value, there are factors that affect. Okay, let me pick it from this side. We'll start with shareholder value analysis. Class, in determination of the value under the shareholder value analysis, in determination of this value for the shareholders, whether in determination of this value, there are 7 factors or 7 drivers that affect the shareholders' wealth, or that affect maximization of shareholders' wealth. You said, I explained that The value-based management is used by company to determine whether there is an increase in the value of shareholders or whether they have maximized the value of shareholders' wealth, right? What are the techniques that we use to determine that? We use the shareholder value analysis, the economic value added, the market value added. Now, the shareholder value analysis or the shareholder value added, how do we determine the value, right? Now, the shareholder value analysis is the process of analyzing the activities of a business to identify how they would result in increasing shareholders' wealth. Class, when is the process of analyzing the activities of a business to identify how would result in what? How do we increase the shareholders' wealth? That is shareholder value analysis. When you are carrying out a shareholder value analysis, you are analyzing the business in order to say, oh, how can we do what? Add value. How can we increase the value of our what? Of our shareholders, or increasing the shareholders' wealth? How can we do that? And the concept of shareholder value analysis believes that in determination of this value, there are 7 factors or 7 drivers that affect the business, that affect the value. Class, am I communicating? In determination of the value, in determination of this value, there are 7 drivers that would affect the value of the shareholders. Or, yes, they call them 7 drivers. And these are drivers that may affect the what? The shareholders' wealth. 1, the sales of revenue. If the revenue decreases over the years under review, or for 2 years, you could say this will decrease the value of the shareholders. At the same time, if it increase, you can say, oh, this will add value to the what? To the shareholder. So revenue. 2 is operating margin or operating profits. If your operating profits increases, you could say that they will add value to the company. If it reduces, the value of the shareholder, we do what? We drop. 3, the costs of capital or weighted average cost. The cost of, when I say cost of capital, you know that it's equity. And the cost of capital, the cost of borrowing. If the cost of borrowing is high, it will reduce the value of the shareholders. That is why when modelers, they want to do evaluation of a business, they will if the, what is it called? The DCF. You should know this by now, though. If the DCF, we already know, do we know that the higher the DCF, the lower our NPV? Do you know? Do we know that? And we already know this now under the NPV. Is that not so?
Yes, sir.
That's
We know that.
okay. Thank you. Right. So, meaning that if the costs of capital that you will use to discount your cash flow to its present value, if it increase, it will reduce the value of the shareholders. 4, tax. If you pay higher tax, of course, it will reduce the value of the shareholders. 5, if you have a competitive period, they call it competitive advantage period. The period, you should know that the more the period has to do with the numbers of years. The higher the period, the more risky is the project, because you don't know what will happen. Something may arise as a result of the future economic events, right? Like what we are facing currently in our economy, right? In our country now. So the higher the period, the more risky is the project, and at the same time, as a shareholder, the more value you create. But whereby you lower the period, the value may be minimal, right? And this could affect the value of the what of the shareholder. We have increase in working capital. That is 6. When your working capital increases, it will reduce the value of the shareholder, right? 7 is increase in non-current assets. That is your replacement. If your current asset is increasing, meaning that you are buying more assets, it will reduce the value of the shareholder. Class, you should not forget that under the free cash flow, the cash flow that is available for the company under the free cash flow to the firm, it is what is available for the company. Then after that, the company can now decide what they will use the money for, either to reinvest into the business or to share it, right? So these are the 7 drivers that could affect the value of the shareholders, right? That could that will affect the value of the shareholders. It's just like if one of the financial institution interest income, because they call them specialized business, because the way they get their revenue, it is different from the normal FMCG, the insurance company, it is actually different from that, what they call that sector, right? That is why they are called specialized business. Insurance company are also specialized business, right? So if we have an interest income for a financial institution and it actually decreases, it is not adding value to the shareholder. It is reducing the value of the words of the shareholders, right? And that is why we have revenue in the other sector. Revenue is also we have revenue in the other sector. So these are the drivers. In fact, even in practice, generally, that is what is applicable. These are the drivers. Now, another thing is, even in financial modeling, you want to build up a model, right? And you have a revenue, you have a cost of sales. What are the driver of your revenue? Is it not cost of sales? It's cost of sales. You have receivable. What is the driver of your receivable? Is it not revenue? It is revenue. You have Payable. What is the driver of your payable? Don't forget, if you want to determine your cost of sales, your payable, right? Your purchases, right? Will be there. What will be there? Is your what? Is your cost of sales? SOG. Yes. So and so on. So these are drivers that actually affect the shareholders what? The shareholders what? Now, I want to explain this. Then we have economic value added. So let's quickly pick a question. Right, let's solve a question on the shareholder value analysis. If you have a question, you can unmute your mic. Right, if you have a question, you can unmute your mic, please. So
Hello,
please.
Mr. Ibrahim. Good afternoon, sir.
Good afternoon.
Yes, sir. Sir, please, I want to know, is there a format for the calculation of that economic added value?
There is no format. Use the format of your normal free cash flow that you have. You get use your format of your free cash flow. You can use the format of free cash flow. So that is what we use.
Thank you, sir.
Yeah, thank you. Any other question? I think Kende.
Brian, sorry, is the economic value added not the one with no parts or something like that?
Yes. It is.
Okay, I think it has formats.
We are in she's talking about shareholder value analysis, not economic value.
She said ever.
No, I said economic ever, sir.
Okay. Sorry. So it has
yes, sir.
Formats. That's formats. We are not there yet. It has a format. Maybe you may need to go and study that one, but let's see how it goes if time permits us, because I just so shareholder value. Okay, I increase in non-current assets. Cost of capital. Cost of capital is the seventh one. Cost of capital. So, Kende.
All right. Good afternoon, Mr. Ibrahim. The 7 drivers of shareholders value analysis. Are they all going to be inside the model for calculating the finance inside the value? Is it?
Yes.
Okay, then
they are ingredients. Yes. Okay, let's call them ingredients. When you want to determine the shareholder value analysis, the 7 drivers are applicable. We will use the 7 drivers.
All right. Yes, we are together, please.
Now that's why I said we can use the format of free cash flow. They are still in the same line. Is that not so?
Yes, they are. And it appears that of all the 7, the competitive advantage period, how can that be quantified?
So that is why if you're a financial modeler, that is why you have to do your research. You have to do your research. You don't just come with maybe a certain period because this period will maximize shareholders' wealth. You have to, because it is now valuation of a business. It is more than the figures. It is now more than figures. You have to communicate to the shareholders. How? They will question you. They will ask you question. How did you arrive at your competitive advantage period and all that? So you have to explain. Do you get? Do you get? Okay. Thank you. Any other question?
Thank you.
Yeah. Any other question? Mary. Mary, are you there?
Yes, I'm here. Good afternoon.
Good afternoon. Any question? Do you have a question for me? I saw a message.
Maybe there's something. I don't have any for now.
Okay. So in summary, right, under the shareholder value analysis, see, these 7 drivers are what we will use to compute the value. And these 7 drivers, they also relate with what is it called? Your free cash flow that you have. You have your revenue, you have your operating profit, you have your working capital, you have if you have what is it called? Add back your depreciation, your working capital, increase in working capital, you reduce Do you get replacement? You know, all these things are all your drivers. So they definitely, even in accounting profit, there are some drivers as well, right? Right. So which I've mentioned, the sales to cost of sales, the receivable, the payable. You know, you need to talk about the loan. You need to talk about a lot of things. So these are drivers that actually what affect the value of the what of the shareholder. So let's quickly check illustration November 2022. Quickly, November 2022. November 2022. Why I decided to touch this part is because okay, it is what it is, sure. Right? It is what it is, and nobody knows where the question will come. And don't forget that like 98%, 98% of tutors, including the professional students, we are not expecting we did not expect what is it called, decision tree last diet, right? Everybody was saying, no, decision tree, like to get so that is why all these short places, all those small topic, they are very, very important, right? And that can give you 20 to 15 marks. So it is what it is. So please let's check November 2020. Let me check. November 2022. Are we there? Are we there? It means
Yes, sir.
okay. I have to share it. Please, can someone read? Who will volunteer to read?
Please, what question? Like number what?
Okay. A minute. Let me check. Okay, question 5. Question 5.
Hello, sir.
I think I have to download this.
Hello.
Yeah, I'm with you.
Okay, so the requirements: analyze and discuss the extent to which taxing PLC has achieved each of its stated objectives. Then the B part: discuss 4 ways to encourage managers to achieve stakeholders' objectives.
Not that.
No,
Question.
that one, no.
That's question 5 now.
November
No.
2022.
The requirement will start from calculate the value of APL equity using SBA now. Aderupoko PLC.
Okay. 17.
It's not about that. I was reading another one.
Okay, that's fine.
Okay, so calculate the value of APL equity using XVA.
Okay. SVA is shareholder value analysis or value added. Okay. Next.
Then the B part: outline 3 methods by which APL director might raise the funds necessary for the proposed MBO of the company.
Okay, MBO. Class, what is MBO? I've explained MBO in this class. Like
Management buyout.
objective. So what is management buyout?
When the management buy probably the company, the existing management of that company, they purchase that company.
But do you think it is normal?
At times it is normal if the shareholders can't, if they can't, like it is normal, it is normal thing. Once
You
they
said
can
it's
see
not
that
normal.
the
Is
business can
it
be profitable in the future,
no, if,
it is normal.
is it not management by objective?
Management by objective, BTBO. Now you know that one. Which one is management by objective?
Mr. Ibrahim, it is normal thing now. It is business transaction, so it is normal.
You said it's not normal because they were there when the problem
Thank you.
started. So why didn't they
Thank
give
you.
your
Thank
opinion?
you. Yes.
Mr.
You are
Ibrahim, this is
absolutely
case
sure.
study now. If I can defend my point, you are saying thank you now.
Okay, I understand your. So yes, if you can actually defend it, it's okay. It makes sense. We can defend it, right? So that's it. What are they looking like? You know that the company is not the what is it called? The either the subsidiary is not doing well and you are there and they want to do a management buyout and you say you want to put it. So definitely you are there. So you want them to sell the business to you, right? So it's kind of reservation because most time I think about it that this management buyout self. How because you be there actually like so many people will question the management, right? Question the management. So quickly, so if you check the performance in this question, you will see that it was very poor because student did not understand how to use shareholder value analysis to determine the value, and it is still the usual way, like what we know under the free cash flow. It is just for you to understand the drivers. What are the drivers? Right? The 7 drivers. If you look at the free cash flow as well, you see drivers, they are drivers. Right? Your operating profit, your after that, your interest, less your interest, you have your profit after tax, you add it back, non-cash item, your increase in non-current assets, your working capital, your this, that is the perspective I want every one of you to look at it, right? It is still a method of valuation of a business. That is why when you look at the syllabus, right? When you look at the syllabus very well, you will see that the economic value are there. The value-based management is under valuation because you can also use it to determine the value of the what of the shareholders, right? So this is 15 marks question. Okay, you can go ahead and read. Okay. Oh. ADB, a large listed.
Aderupoko.
Question 5.
Aderupoko.
ADB, a large listed media group, has been the holding company of Adamu Publishers Limited. Class, what is holding company? What is the holding company here?
Group.
We know.
Parent company.
Thank you.
Parent company.
Thank you. ADB is the parent. Please mute your mic. Is the parent of APL, right? while APL is the subsidiary. Since 2015, the publishing company APL is 100% owned by ADB since inception. Recently, the directors of APL informed ADB board of their readiness to make a management buyout. Recently, the directors of APL, imagine, inform ADB's board of their readiness to make a management buyout of APL. Imagine. Accordingly, ADB board decided to value APL using the shareholder value analysis method. ADB board ADB board estimated that APL has a competitive advantage. Imagine, APL, they are ready to buy APL. The directors of APL are ready to buy APL. Then ADB, which is the parent company, has, oh, look, when you want to determine the value, you have to use the shareholder value analysis. You want to know the value at which the company has created. So with that, that will be the value of the business. So now the board now says that, oh, excuse me, that APL has a competitive advantage over its competitors to 30th September 2024, meaning that the competitive period where the company generates more revenue is for 4 years, right? Over the period at which the company generates revenue over its what? Over its competitors. Now, Kenny, can you see it now? When you're building a model, that is why when you're building a model and you have to, what is the numbers of years? In this period, you have to know that, oh, this period, this is what will happen. And it is not by calculating it, it is by defending the what? The competitive what? The competitive period. And the following data regarding APL value drivers. The value drivers and additional financial information has been calculated. Sales for the current year. We're given the sales for the current year, 80 million. Annual depreciation and equally to annual replacement of non-current assets expenditure. Class, the annual depreciation can also be equivalent or will be equivalent to the replacement of non-current asset, and it is annual, right? So meaning that your annual depreciation, right? Your annual depreciation equal to annual replacement of non-current assets. What it means is that the more you replace your assets, the more you have annual depreciation, which is 2 million. Par value of 6%. Debenture in issue. Current market value 95 naira. Nominal value is 100. Then we have the amount, right? This is the current market value, 95 naira per one. This is the nominal value. This is the value given to us. This value does not mean that this is the market value. We know how to determine the value of a debt. Is that not so? If you use this 10 million divided by the nominal value times the market price, we give you the number. They will give you the value of the debenture. We have a short-term investment, which is the company assets. The short-term investment. This short-term investment may be commercial paper, may be treasury bill. Is that not so? And this could be classified under current assets. We have this. The company tax rate is 20%. The current WACC of the company is 10%. Year to 30 September budgeted. We're told that the sales, can you see that sales is among the driver? Operating profit is among the driver. The incremental non-current assets is among the driver. The incremental working capital is also part of the driver. Class, am I communicating? So, required. This is 2025 plus. What does this mean, class? 2025 plus.
Infinity.
Beyond. Thank you. So, required. Calculate the value of APL equity using the shareholder value analysis. Imagine you are told to determine the value using the shareholder value analysis, and they for equity, and they gave you WACC, and it is for equity. So we have to go back the usual way, right? What we did in our previous class. So we have this to be 12 marks, then this. Suggested solution. Okay. Suggested solution. November.
So I can't see your working screen.
Away. Okay. Can you see it now?
Yes, sir.
Yes.
November 2022. Question 5. What is the name of the company? They say we should determine the value for APL, right? APL determination. Determination of equity value using shareholder value analysis. Then based on the information, 2023, 2021, 2025, beyond. 2021, 22, 23, 24. and 2025 plus. Of infinity. So remember, this is very important. Okay. Now, class. The sales, of course, when you want to grow something, they have to give you the current year sales for you to grow it. And it is given as 80 million. And this will grow by 5%, 4%, 3%, 12%, and 0%. So therefore, sales we grew by 80 million times. The first year we grew by how many percent? By 5%.
5%.
Times 1.05. What do we have?
84.
Yeah.
We have 84. Why? We will have a growth of 4%. What do we have? What do we have for a growth of 4%? What do we have? If you grow this, what do you have? What do you have? Quickly.
87.36.
87.36. 87. So we have here 3%. If you grow this by 3%, what do you have?
90.
90.
So 90. The next growth is what? 2%.
92.
92. The next growth is how many percent? 0. Right? We have 0. Right? You go it with by 0%. You have 0. Is that also class?
Yes, sir.
Okay. So, based on the information given to us, operating profit margin, don't forget, if you are given operating profit margin, meaning that they've jumped cost of sales, right? They've jumped towards cost of sales, and they've jumped cost of sales. Your 8%, Kende,
Well done, sir.
there will not be growth rates. We will have 92%, right?
Yes, that's what I want to call your attention to. Thanks.
Okay, yeah. Yeah, I saw it now. 0%. Meaning that it will not grow. You will still have the same 92%, right? So we have this. The operating profit margin. Can you see it? So if we are given operating profit margin, just like the way we did under the margin acquisition, so they've actually skipped the part of cost of sales. Then operating profit margin is usually on sales. Can you see it? Operating profit margin, 8% of this, 9% of this of sales, 10%, 10%, and 10%. So therefore, we can have operating 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 profit margin to be how many percent
8%.
of sales? Percentage of sales. So 8% of this, what do you have?
6.72.
6.72. The next percentage is what?
9%.
Okay. So what is the 9% of this?
7.83. That's it.
7.8.
7.83. 83.
So next, what do you have?
10%.
How many? No. What do you have? What do you have? 10% of 90. What do you have?
9.
So what do we have here? How many percent then?
9.2.
We have 10%, right?
Yeah. 9.2. 9.2.
Okay. 9.2. 9.2. So when you have 9.2, 9.2, after that, what next do we have? Don't forget you have depreciation. Class, don't forget that you have what? You have depreciation, annual depreciation. What is the annual depreciation for the current year? It's 2 million. Is that not so? Hello?
Yes, sir.
Yes,
Annual
sir.
depreciation. Annual depreciation is 2 million. The more you replace your assets, it's equivalent to annual replacement of non-current asset. Of course, the more you replace your assets, you will have a depreciation. Is that not so? Because you have to depreciate your assets. So depreciation depreciation 2 million annual depreciation. Annual depreciation
Sorry, just to confirm. I'm not the only one not hearing you.
Okay, sorry, I think my network. So what do we have here? What do we have? If you subtract this,
4.72.
okay, 4.72.
4.72.
So what do we have here?
5.83.
5.83.
5.83.
7.
What do we have here? 7.2.
7.
Last one, 7.2.
Okay. So we have our tax. What is our tax rate? 30%, right?
Yes,
Corporate-
20.
Tax is 20%.
It's 20%. So, okay, come, let me share my entire screen. Okay, tax is 20%. What do we have here?
So I have a question, sir.
I'm still working on this. We are not done yet now. So let us finish this, please. Thank you. So 20%, what do you 0.94.
94.
A minute. Let me check something. Okay. Next.
1.17.
1.2.
1.2.
1.4. Is it 1.17 or 1.2?
1.17.
1.17. Next.
And 1.4.
1.4.
Next.
1.44.
1.44. Next.
Same.
Okay, thank you. So, what do I have as profit after tax?
3.78.
Profit after tax. 3.78.
78.
78. What do we have here?
4.66.
4.66. What do we have here?
5.6.
5.6.
6. What do we have here?
5.76.
5.76. What do we have here?
Same.
5.76. I'm not even looking at this thing anymore. Okay, so okay. After this profit after tax, then we can now go back and do the usual, right? Because you want to determine value. Value is not based on accounting profits. We have to add back our depreciation. Is that not so? We have to do what? We have to add back our depreciation. When we add back our depreciation as non-cash item, we will come here where we have incremental non-current assets. Is the percentage of sales increase. Incremental working capital, a percentage of sales increase. I think this is what's confuse the students, like how will they arrive at this percentage sales increase, and the one for non-incremental non-current assets, as well as incremental working capital. Right. Another problem here is students for this part of it, right? Look at it here. So please check. Are you still with me, please? Can you see it? Annual depreciation. It is annually. Is that not so? It is annual. So someone wants to ask question quickly. Who is that? You can quickly unmute your mic. Quickly.
Sir, you said something like we can also use FCF method of doing it. So when we got the operating profit, I was thinking that we just make it like a bit and do less of tax, add
I'm not
NCC.
I'm not using that format. Oh. The format
Okay,
the
sir.
format I've been using is this format of profit after tax, add back depreciation. Is that also like format I've been using? So if you think that format will work for you, please use it. Please use what works for. But this is what works for me, right? So Kende, are you there?
Yes, sir. I'm here, sir.
Okay. Don't worry. Yeah, let's move on. So add back depreciation because it is non-cash item. Non-cash item. So the next thing we need to do is to check from the question incremental non-current assets. So we will have incremental non-current assets. This will be a work one. So you can come here, workings or appendix one, incremental non-current asset. So incremental non-current assets as a percentage increase of 5% sales, right? Now the question now is, let's check. (2021) class. It is incremental non-current assets as a percentage of sales increase class. Now the question now is, what is sales increase? Year 0, you have this. Abi 2020, you have this. From this, it has increased to this. So what is the sales increase?
4.
So we have 80 minus the increase. Should I use 80 minus 84? 84, or you use 84 minus 80? No. Times What is the growth rate given to us? 5%. Is that not so?
Yes.
Yeah, 5%. So you increase it by 5% as a growth rate. What do you have?
4.2.
4.2. So we have for 2020, 2022, right? In 2021, the percentage increase, the increase in sales, can you see it? From 87, sorry, from 84 to 87. Is that not so? So we can have 84 minus 87, 84 minus 87 times, what is the growth rate given to us? What is the growth rate, class? 6%. You grow it by 6%. What do we have?
3.18.
3.18. 3 point, sorry. 3 point what?
8.
1.8.
Okay. 2023. Don't forget. The examiner sales as a percentage of sales increase, meaning that when you want to get your incremental, you have to start from something before you will increase it by 5 or 6%. And I think this is where you need to unlock the question, right? As a percentage of sales increase. So the next one will be 87 minus, what is the increase in 2023? 90, from 87 to 90. So we can have minus 90 times how many percent?
3%.
It should be 90 minus 87. No.
3%. Anyone? What do we have?
3.1.
3.09.
3.09, right? 2024, you can change it to 84 minus 80, 87 minus 84, 90 minus 87. Fine. All what we want to determine is the increase, right? Is the increase. So you can use it like that. So it's fine. Anyone? So the next one is, we can use it as 90. Okay, let's start here. 90
minus 92.
Minus 92. So it will increase by 2%. 2%, right? 2%. So what do we have here?
2.04.
2.04. 2025. So we have 92 minus 92, and it will increase by 0%, right? How many percent? Okay, by 0. Right.
No increase.
So we have this.
No.
So therefore, you come here, your non-current assets, 4.2. Then after 4.2, what do we have? We have 3.18. We have 3.09. Then 2.04. So we have 0. Next, is incremental working capital. The incremental working capital will also be on this, right? The incremental working capital will also be on this. Now, don't forget. Okay. So the incremental working capital will also be on percentage of sales. Is that not so? Class 6%, 5%, 4%, and 0%. So we can come here and incremental working capital. So this will be work 2. Incremental working capital. So you will just give me the percentage. The percentage increase, right? For each of the year. So what is the percentage increase under incremental?
6%.
6%. So next, what is the percentage increase?
5%.
5%. Next.
4%.
Next.
4%.
Next.
0%.
Okay, so what do we have here?
4.24.
4.24. What do we have here? Oh,
3.15.
3.15. So what do we have here?
3.12.
3.12. So what do we have here?
2.08.
2.08. So what do we have?
And 0.
Okay. Please just call the figure, right? 4.2, 3. You can screenshot this part, right? Are we there? Okay. So the first one is 4.2 what? 4.2.
4.24.
4.24. Then what do we have here?
3.15.
3.15. So what do we have here?
3.12.
3.12. So what do we have here?
2.08.
2.08. 2.08. So what do we have here?
0.
Okay, 0. Okay, Dari.
Yes, Mr. Ibrahim. Mr.
I'm with
Ibrahim.
you. I'm with you.
That first year, the incremental is 4 million, right?
Yes.
So the percentage, 5% of 4 million, will it be up to that figure?
I don't know.
It can't be up to that now. The difference is 4 million. If you now take percentage, you are now having 4.2 again. So something is wrong somewhere.
Okay, that's fine. Okay, let's check it together. What happened now? Oh, okay. Okay. So we have the incremental is 80 minus 4. 84 minus 4, we have 4. Is that not so? We have 4, right? 5% of 4, what do you have?
Is it 5% or 1.05? I don't know.
1.0, like, is it increasing or just a percentage of it?
Is a percentage. Is a percentage of it. Just like
Mr.
the way we
Ibrahim, we are good in our working capital way. So that
wait.
we-
I'm coming now. Let's quickly go back to the question. Oh. Okay. Are we there? So now, if you look at the gross profit margin, it is how many percent? You can see that the first one, the examiner says sales growth. The examiner indicates sales growth. Is that not so? The examiner indicates sales growth. Here we have operating profit margin that it is 8% of sales. The same thing applicable here, right? The percentage here means that the sales increase, before you calculate, before you get your sales, you use a percentage to increase the sales, to have your sales growth. Now, what will be the increase in the sales growth, which is the sales increase, which is the difference between 2020 and 2021? Is that not so? Which is what? The difference between 2020 and 2021, which we have 80, 84 minus 80. That is the increase given to us. But in the percentage, I didn't even see it. In the percentage, the examiner did not say this is, what is it called? This is growth rate. Oh. Did the examiner say, oh, they say incremental non-current assets? That is why you have your sales. It has already increased already. If you look at it here, you've already increased it because you are looking for the difference between 2021 and 2020. You've increased it already. And that increase, right, you will have 5% of it. Hello?
Yeah, we are with you.
Okay. Are we still together? The examiner says the percentage increase, we already have an increase. To be 84 minus 80 is the increase in sales, which is 4, right? And we have 5%. This 5% that we have here, the examiner did not say growth rate. Is that not so? It will be 5% of the increase that we have, not that we grow it. People say it, right? Not that we will grow our answer. We are not growing it. Oh. Are we still together?
Yes. I was wondering.
Because our incremental non-current assets, incremental, it has already increased. The difference between 2021 and 2020 is incremental. Is it not incremental? It is. Then the examiner says 5%. The examiner did not say, oh, you will have growth, just like the way they wrote in sales growth. Please, are we still together, please?
Yes, sir.
Yes.
Yes, sir.
Thanks for the observations.
So, thank you. So, what do we have here?
0.2.
Just remove the first letter, first number, 00.
Okay, we have 0. What?
0.2.
0.2.
This
This
one
will
is
be
0.18.
okay.
0.09.
Okay.
Yeah.
Yes.
And 0.04.
0.04.
Okay. Thank you. I didn't check it, honestly. I just Thank you. That makes sense. Oh, so 0.2 0, we have 0, then we have 0, right?
We should check our working capital as well.
Yes, working capital, yes, sure. So this will be, we have 0, right? Please confirm this.
Correct.
Okay. 0.24, 0.15, and 0.12. So 0, right? I know most of them will grow it. Yes, that is why if you read the examiner comments, very poor. Performance was very, very poor because students did not know even how to apply the shareholder value analysis. And even if they know, the part of this increase is a big problem, right? And someone will look at it that it is incremental. It is incremental now. Let me use 5%. You just increase. You've already increased it. You have increase. What is the increase? That increase is incremental. So charge 5% of it. The examiner did not say, oh, it will now grow by 5%. So please, let's take note of that, please. So, having done this, what will be our figure before our DCF? What do we have? I think we don't have any other information again. Do we have any other information? No. Do we have any other information? We are talking about company here. Is that also class?
Yes.
We are
Yes,
talking
sir.
about the company, right? And the examiner using, they say it is equity, the value, using the shareholder value analysis. So we'll have to discount. We're given with the weighted average cost of capital, right? Weighted average cost of capital. What do we have here? Are we still together? Away.
Yes, sir.
Yes, sir.
Okay.
6.22.
6.22.
6.99.
So what do we have here?
6.99.
6.99. What do we have here?
7.81. 7.81.
Okay, 7.81. What do we have here?
Please, let's confirm. It's like it's wrong.
Ew.
Please, it's wrong.
It's wrong.
I think the first year is
2021 is 5.34.
5.34.
Increase, okay.
5.34, 6.33, 7.39, 7.64, 7.7.
Okay, calm down now.
6.33. Others may also
6.33.
Yes, 7.39.
7.39. What do you have here?
7.64.
7.64.
Correct.
7.76.
7.76. So, class, we were told that we should discount with the weighted average cost of capital, right? We're told that we should discount this weighted average cost of capital. Don't forget, class, we want to determine the equity value, not the company value. And the examiner will always test you by giving you the WACC. Then it's now left for you to now remove the value of debt, and so that it will remain the value of what? Equity. And you should not equally forget that the current WACC includes the debt and equity. Debt and what? Debt and equity, class. So therefore, if we have the DCF, excuse me. What is the DCF? 10%, right? Hello?
Yes, sir, 10%.
Yes, sir.
Ah, let's say I know this class, so it's in the apple now. Okay. Mr. Temitope, 10%. Okay, what do we have here?
0.91.
0.91. 3 decimal.
Okay, 3
You
decimal.
not
0.9 0.909.
909. Next.
0.26.
0.0826.
826.
Next.
0.751.
0.751. Next.
0.683.
0.683. Next.
0.621. 621.
Okay. Right. What will be the present value? Value
4.85.
4.85.
Free cash flow to the firm.
Yes.
Free cash flow to the firm. So the first one, what do we have?
4.85.
4.85.
4.85.
4.85. Next.
5.23. 5.23.
Next.
So it is 5.20, not 5.23.
Next.
5.55.
5.55. Next.
5.22.
5.22.
4.82.
4.82.
The last
82.
year. 4.82.
4.82. Right. Okay. So what is the total value? The company value?
25.67.
Total market value. Right. What do you have?
25.67.
25.67.
Okay. Thank you. 25.67. Now, there is infinity, class. You should not forget that there is no infinity, sorry. What you use to discount it, it is the company WACC. And the company WACC include both equity and debt. But the examiner says calculate the value of APL, equity, right? Calculate the value of APL equity using the shareholder value analysis. So therefore, this is the total market value of the company. We should not forget this, that total market value is equals to value of equity plus value of debts. Addition of the two is total market value for the company. Now, since we have this as the total market value, we should not forget that the company has an investment which is part of the company fund.
And a sort of the infinity value.
Okay, 2025 to beyond. Okay. Let's do it this way. So this our DCF is actually wrong, right? Because the examiner says 2025 beyond. Beyond means to infinity. Is that not so? So meaning that when you want to determine your DCF, your 2025 will not just be the growth rate, the DCF for 2025. It has to include, we have to include beyond, which is infinity. Then the question is, how do we get that? So therefore, for you to determine your DCF for year 3, for 2025.
Hello, sir.
The 2020.
So hello,
I'm coming now. Oh, I'm coming.
Sorry, sir.
So the DCF for 2025 is 0.625, 0.621. This is wrong because the examiner gave us 2025 beyond, which is plus. So the DCF that you have should include the beyond, the 2025 and beyond. Is that not so? Now, how do we determine the infinity? Let's say for you to determine the infinity, if you want to determine the infinity DCF, it is usually 1 divided by R. Your R is the DCF. 1 divided by
10%.
By 0.1. What do we have? 10. What do we have?
10.
We have 10. So therefore, this is beyond. This is beyond. And you have for the one of 2025 to be 0.6 what? 2025 is what, sir? 0.621 for 2025. Then beyond times 10. What do you have?
6.21.
6.21 what?
Just 6.21.
Okay, 6.21. So therefore, our beyond 2025 beyond, right? 2025 beyond DCF will be 6.2. we would have used 0.621 if it is just for 2025. But because the examiner says 2025 beyond, so meaning that our DCF will be beyond 2025 beyond, that is to infinity. So we cannot have here to be 0. What do we have, Seth? What do you have? 6.21. 6.21.21. So what do we have here? When you multiply, what do you have?
48.19.
48.119. Okay, 19.
Yeah.
Right? So please always take note of this when the examiner says beyond. Your DCF should not only be for 2025, your DCF should include the beyond, right? Stated in the question, right? So you can quickly unmute your mic. So let me take question before we continue, please. Please unmute your mic.
Hello, sir. This number 3, working is not clear.
Okay. Next question.
All right, thank you, Mr. Ibrahim. I want to ask for this beyond. I think for our past questions, the questions we've solved in this class on business valuation, we've always done the infinity part of it separately. So what makes it different here that we have to include it in the last year figure?
Yes, because this is according to the question. Can you see it? The examiner gave you 2025 plus. It is different from the one we've been doing. Is that also? What we've been doing is growth rate. They will give you the terminal value that this will increase by this thereafter. Are we given any terminal value here? No. The examiner wants to test your knowledge if you understand how to determine the DCF for beyond, not only for 2025. Right? You have 2025 plus. There's no terminal value here that you want to say, hey, growth rate. No. This is talking about the years, not the figure. Right? Now, the year itself will not affect our DCF because we do our DCF based on the numbers of years. So we cannot just put the 0.625. If we put 0.621, that would be for 2025 only. But the examiner says beyond. You have to calculate the infinity, the DCF for infinity. So for you to get that, you have to calculate the infinity formula is this for DCF. Can you see it? 1 divided by R, which is this, 10. So for 2025, you have this. Then beyond times 10 will now give you 2025 plus. And that is how we arrive at 6.21. Do you get that?
Yes, I understand now. Thanks a lot.
Welcome.
Hello, sir. I want to ask a question, sir.
Please go ahead.
Thank you, sir. The operating profit margin. To me, I thought you already included depreciation. So I came in late. Let me just confess, I came in late. But I thought
no worries. And I don't think I will answer that question. I'm sorry about that, right? You came in late. I'm so sorry about that. So you just have to go back and watch the video on YouTube, right?
Yes.
Thank you. Thank you so much, sir.
Mr. Brian, that number 3, the working is lump sum. Please demarcate this. Let me see the what's it called? The formula aside from the workings.
I don't understand. This is it now. 1 divided by R is the formula. 1 divided by 0.1 is equals to 10. Right? This 0.625 is the DCF. DCF for 2025 is 0.625. Then beyond to infinity, this is the infinity formula, DCF that you will calculate. Then when you multiply it, we give you 2025 plus, that is beyond.
Case settled. God bless you, sir. Thank you.
Thank you. So therefore, what will be our present value of free cash flow to the firm?
73.24.
73.24. Now, Mr. Temitope, let me quickly answer your question.
Oh.
Right? You see this
It's actually
operating
69.04.
7?
It's 69.04.
69.
69.04, sir.
69.04.
Okay. So let me quickly answer your question. This operating is that is why I said we should not always assume we follow the examiner instruction. The examiner did not say the operating profit include depreciation. Or is there anywhere it is being mentioned? No. The examiner did not say the operating profit include depreciation. Or, and that is the reason why we separated it. The examiner says annual depreciation. The examiner did not say operating profit include depreciation. Please, we should not set question for ourselves. It is based on the examiner point. Mr. Temitope, do you get that?
Sir, I'm trying to get you, sir.
Okay, you can check it.
For me, operating profit is after deducting depreciation.
Mr. Temitope, that is to you. Is that not so? But that is not the word the examiner says. What is operating profit?
Profit after tax, after depreciation, order of the principle.
That is what you assume. Is that not so? Now, in this, you can see that the examiner gave the annual depreciation to be this. Is that not so? Now, that is a very good observation that share is operating profit. We're supposed to have include the examiner did not say operating profit include depreciation.
Mr. Ibrahim, but what me I'm even feeling like is that it is one of the 7 factors we need to consider when doing the
yes, what he's actually claiming is not even that one. It's not even the part of operating profit. He's saying that this depreciation, since it has been included here, and we should not bring it again. So I think that before we arrive at operating profit,
we deduct it earlier, so we have to add it back based on.
No, his own claim is that we should not have deducted it. That since they've done it in this, according to him, they've deducted it to arrive at operating profit here.
I'm also seeing it that way too, Mr. Ibrahim. True. I'm also seeing it.
We'll be examiner.
Okay, interesting. Who is also seeing it in that way?
To add it back. To me, I see that there's no need to add it back, only to deduct. I mean, there's no need to deduct, only to add it back when we are to calculate the free cash flow. That's the way I see my answer.
Okay, that's fine. Any other observation?
I think I'll go along with what they've been saying. Yes, now because on the operating profit, it was not said that it included of like the one we used to do.
Yes. together. So we don't know whether the examiner says, I don't think it is. I don't think it is actually included. I think it will have been stated that the operating profit will include depreciation, right? Include depreciation. So, so it is what it is, right? Right. It is what it is.
Mr. Bowen, we can always state our assumption now if they are doubting the exam. Since we didn't, I've been to clarify so the examiner will be mark your friend.
You state assumption. Yes, that's true, Sha. That's true, Sha. You can also state your assumption that it is assumed that operating, what is it called? Operating profits, depreciation is included in operating profit. Is that not so? That would be the basis of assumption. So let's continue, please.
Thank you, sir.
Yeah, you're welcome. So now you should not forget that if we have this, right? If we have this, where is it? Where is it? Now, the short-term investment held is for investor. It is their money. Is that not so? It is for investment. This short-term investment may be commercial paper, may be treasury bill, right? So therefore, short-term investments. What is the short-term investment? The figure 0.8, 0.8, 0.8, or let's remove debt first. So when we are done with, okay, no, let me do it this way. So this is the total market value of the company, which include both equity and debt. But the what is it called? The question says we should determine the value of equity. Right? What you have here is the value of the company, both equity and debt. So therefore, we need to deduct our debt, market value of debts. So what is the market value of debt? You can see in this question, it is not even in percentage. We should not forget that sometime they will give you market value of debt, which is usually in what? In a percentage. Maybe 60 or this or that. Now, if you look at this now, so what is the share? The market value is 10 million, right? This is debt. The market value is 10 million, right?
No, 9.5.
Eh?
9.5.
9.5.
Yes.
Okay, for me,
60% debenture.
Yes, no, like before converting it, it is 10 million. So we have to use the nominal value and the other value that was given.
So how do we now determine the value?
And that would be 95 over 100 times the 10 million.
Okay. So we have, this is like the value given to you in the statement of financial position. Remember cost of capital. 10 divided by the nominal value.
Yes.
Times the market price.
Thank you, sir.
Yes.
No.
This is very important. So you can see in some question, they will give you the percentage. In this question, you have to determine the market value of the debenture. What do you have here?
9.5.
5.5. You have to subtract it because this total market value here include both equity and debt.
It's 9.5, sir.
It's 9.5 or 9.5.
What do you have?
5.5.
9.5.
Yes, 9.5.
10 million divided by 100 naira.
So,
Times 95.
so the total market value here, it includes both your equity and debts.
It's time I beg that 10 million put more so that we not think is be looking for 10 naira. Thank you, sir. Yes, sir. I was looking for the 10 naira until you mentioned 10 million.
So if you deduct it, you have your equity value. When you deduct it, what do you have?
59.54.
What do you have?
59.54.
59.54. All right. And the company has a short-term investment held. They just keep one investment for one side. So it has to be part of the value. It has to be the part of the value. So what is the short-term investment? 0.8. 0.8. So what is the total value of equity?
60.34.
Total value of equity. 60.34. It is what it is, class. The total market value here include both equity and debt. What we want to calculate is the value of equity. Remove the part of debts. You have this equity. The short-term investment held, it was not stated the kind of short-term investment. It could be equity mutual fund. Yes, it could be mutual fund because it is short-term, maybe for 3 months to 6 months. So it is part of equity. And that is why we added it. Thank you. Any question? This question is very technical, somehow sharp, because if you don't understand, you said so it is what it is. It is somehow it is somehow technical. You know, we have to unlock some things here. You should not forget this. Please, we should not set question for ourselves, please. Follow what the examiner says you should do. If the examiner says this include this, we know that it is included. If it is not, stick to assumption. We assume that it is not there because it doesn't stay there. How will I know now? When they say operating profit is 8% of the sales, right? Although in our accounting knowledge, we can say, no, depreciation is supposed to be included, right? So you can see that when we want to determine our incremental non-current assets, we check for the difference as a percentage of sales increase between 2020 to 2021. What is the increase? It is an incremental, and we have 5%. What is the 5%? 5% of it will be the incremental non-current asset. Please, we should not set question for ourselves and grow this, because the examiner did not write growth rates, that this will grow by 5%, just like this. The same thing applicable to working capital. This, the increase. Then we have to charge 6% of it. Class, it is what it is. Question. Oh, it is. If you have question, Kende.
All right. Thanks a lot, Mr. Ibrahim. Very grateful. So I suppose that we are actually solving this question on under shareholder value analysis. Am I correct?
Yes, please.
So how has this been connected to shareholder value analysis? Because this appears to be the same thing that we've been doing in
Yes.
the past meeting. How are they connected? What's the synergy? What's the ingredient?
No, the this thing is what's I don't think that's why at the beginning of our lecture I said that's a very good question, right? I said the value-based management is a form of valuation of a business. It can be used for valuation. And that is why I say examiner may ask you to calculate, use shareholder value analysis to determine the value. Is that not so? Then you have to consider the drivers. Then you think of two things. One, the drivers. Two, your free cash flow knowledge. Based on what is given to you, you work with it. So it is not far from valuation of a business. We are still valuing business. You should not forget that AP, APL is a subsidiary. No, wait, APL is, what is APL? APL is the parent, right? Is it the parent?
Subsidiary.
No, it's a subsidiary.
Subsidiary.
Okay, it is subsidiary, right? APL is, I'm trying to the page. I'm trying to check something here. Where is it now? Okay, APL is the subsidiary. So the subsidiary, it could be that the subsidiary is not doing well, it's not performing well, right? It is not to do what? It is not performing well, and they want to do what is it called? Management buyouts. And we should not forget, there is it is still valuation of a business. Don't forget, economic value added is used for valuation of a business. Shareholder value analysis is used for valuation of a business. Market value added is used for valuation of a business. So we are still talking about valuation. Do you get? Now, the management buyouts, you sell to the management. Why? And there is management buyout. Examiner may ask you what is the difference between the management buyout and management buy-in. When you sell to the internal management, that is management buyouts. But when you sell to the external, which is external, right? That would be what? Management buy-in. That would be what? Management buy-in. However, management buyouts, management buy-in are forms of divestment. And this divestment will take us to reorganization, right? Reorganization means that when company, it is not because they are not performing well. Reorganization did not occur that because the company, or the subsidiary is not doing well. No, reorganization occur if a unit, not the company, if a unit is not actually performing well, you have to do what we call reorganization. Then reconstruction is when the company may likely liquidate, fail, and that's will take us to corporate failure. Is that not so? So the reorganization, how do we reorganize? And that will take us to divestment. Hereby, the reorganization, a particular unit is not performing well. So what do we do to this? You reorganize, right? Then we have forms of reorganization. How do we reorganize? That will take us to divestment. Divestment, you sell the units, you sell it out, either to the internal or to the external. And that is why we still have the form of divestment. There is the management buyout. There is management buy-in. And there is also a split off, right? There is also what? Split off and what? Spin up, right? These are form of what? Divestment, right? So class, it is what it is. So are we good? 221. So I think I'm done with today's class, right?
Mr. Ibrahim, you are preparing for a Chelsea match. I know. They will
No,
beat
no, no,
us.
no, no. Me.
They will beat us.
Waiting there my front now. A past Chelsea match. Oh. You can see I dey sweat. I'm under pressure.
That is
Probably
that kind
let
of
me
sir. You
scroll
will be
to
sweating
the
under
last
this.
workings.
Take
It be
water,
as if
Mr.
Let me
Ibrahim.
scroll to the last workings.
Take water.
it be as if I dey under pressure as I dey like because my mind is not in this class again.
Mr. Ibrahim, you are not doing that kind
Mr.
exam
Ibrahim,
now.
take
That you will
water.
be sweating under it.
It's not water issue here. Oh. Okay, this one pass water. Oh. So you can always check it out on YouTube. Please, you can learn economic value added. Please, you can learn economic value added. Don't be surprised.
But give us the format for that economy. If that's what you will do for us, just give us the format, sir. Please. Yes, sir.
Okay.
Hey, wait.
Who be this one now? Okay, I think I need to take water, right?
Yes.
So, Madam say I should give a format for Eva. Okay, can you say?
Hello, Mr. Brian.
I'm with you.
Good afternoon, sir. I want to appreciate you for all the efforts you have been making so far. So, but my question is this: that at this point now, what is the next thing? Like, I thought you said you are going to do investment appraiser, but I don't know the plan. But my
We'll do
question
what?
is that
We'll do what?
Investment appraiser.
Wait.
International investment appraiser.
Yes. That one is on Monday. We'll start it afresh.
Okay, Monday. Okay.
That will be on Monday. We use Monday for international investment, Wednesday for international investment, Saturday for international investment, then 1 week off. Everybody go and see all those ones where you don't learn, go master them first. Then we'll come back in intensive class. In intensive class, we'll look at different questions again. So that is it.
I can't in trouble.
They play. You better prepare yourself. Prepare well. So,
what about capital reconstruction?
Yeah, I don't have the time for the capital reconstruction, honestly, but I hope I have that time. I hope we have that time in intensive class, right? I hope we have the time for capital reconstruction. If I should just chip in capital reconstruction, even if it is just one past question. Even if it is just one question, right? Very simple. Really, I will try it. If it is possible, fine.
Okay, sir. I want to ask: is there any topic like edging the forest part of this thing? Like, are we?
Yes, there is. Now. There is always edging. There is.
Are we doing it?
No, we are not doing edging. One of the edging tools is option pricing. You should not forget that option is used for what is it called? For edging, option market. Is that not so?
Okay. Yes,
option
sir.
market. So we've treated one part of it, right? It's still remaining the money. We can't start. If we want to start edging, we will not finish in a month. That's just it. That is the honest truth.
Okay.
Right?
So
And then I'm with you.
Good afternoon, sir.
Good afternoon.
Please, sorry to take you a bit back, but I was going through the solution. Then I was asking myself on that 2025, the sales growth was 0%. So if you multiply it by 92, how did it also be 92? I was thinking should be 0.
No, it means that there's no growth at all. If you have 0%.
There's no growth. All right, thank you, sir.
You're welcome. Any other question?
Let's call it a day.
Thank you. So, please ask question. No.
Somebody just the job.
I know they understand your languages, so.
Please ask question. Ask question. Ask question. If you don't understand, drop your question in the general group, right? I will definitely do what I will definitely attend to it, right? So on this note, thank you, and I want to apologize for joining late. 20th of October, which is this month, right? Which will be different from what we've done, in class, even if we would pick some past questions. Be forwarded to send Google immediately after the class. Right. So, yes, of course, case study we hold. I think maybe next 2 weeks or next week. So tomorrow, I think we'll communicate the time for case study tomorrow. Yeah, there should be case study class because we need to complete. We need to complete the answer plan. From the answer plan to how to draft cover page for both internal reports and external reports. Thereafter, we do small analysis, right? We just do like maybe 2 to 3 exhibit analysis. Then we are done. So wait for intensive class. Right. So thank you so much, everyone, for joining. Please feel free to send your question. Please don't send it to my DMs. Forward it to the general group. I will definitely see it and attend to all questions. Right.
So that intensive class will be night, Abby.
Yes.
Hey.
Yeah,
Hey.
I
always sleep.
So, all right. On this note, thank you so much, everyone, for joining, and enjoy the rest of your weekend.
Thank you.
And study very well. Okay.
Thank you, sir.
Please.
God bless you.
Yeah, amen. And you too. Thank you all.